So if you're thinking about buying a home in 2023, now's the time to start preparing and planning for this. So watch this video so I can guide you through the process. And also 94.4% of you that watch these videos, and I'm glad that you do, haven't subscribed yet. So if you're enjoying this information, definitely subscribe to learn more. So the first thing I want to start with is your credit. We want to make sure your credit score is good. Now you can go to Equifax, Experian.com, TransUnion. You can go in there and get a free credit report and see what your score looks like. If you're not sure how to read it, let me know and I'm happy to walk you through it. The good thing about looking up the credit score early is if there are a few blips here or there, you can have plenty of time to get this fixed. And that way we can make sure your credit's as good as possible, which can save you thousands of dollars by getting the best rate you can. Now the goal you should be reaching for in your credit score, if you have no other idea, is 740. It can be different from what you get online compared to what we run as a mortgage, so the higher the better. But don't worry if your credit score is not 740 right now. There's still time to improve it, and even if you can't, you can still get a mortgage with as low as a 620 credit score. So the next thing we want to do is talk about income and your employment situation. Now we're going to look for a 2-year employment history, but it doesn't have to be at the same company, which is good. Also, if you just graduated, we can use the time in your college as part of that 2 years, so you don't have to worry about actually working for 2 years if you're in college before that. Now, one thing with this 2-year history though is if your income is salary, great. Or if you're guaranteed 40 hours a week, that's perfect. We can use that and it doesn't have to be over 2 years. But if you have variable income like overtime, or your hourly goes up or down, bonuses or commissions, or even if you're self-employed, now we need a full 2-year average to kind of look at that and to make sure that income is consistent and stable. And if you are self-employed, there's a lot of different programs out there besides what fits in the normal box. Like we have bank statement loans, for example, to where we don't even look at your tax returns. We just look at what's deposited into your bank statements every month, and we can actually use that as income. So just because you think you might not qualify for a loan because you haven't been at the same job for 2 years, there are lots of options out there. The third thing you want to keep in mind is your assets. And by assets, I'm not talking about like if you own a car or fancy paintings or gold or jet skis or whatever. We want to make sure that you have money, what's what we call liquid. So liquid assets is going to be checking, savings. We're even going to use retirement funds, stock options. What we want to have is that you have enough money to have a down payment and cover your closing costs. So just like the income, there's a lot of variables with this as well. So you might not have all that money in your checking account, but maybe you have a family member that can give you a gift, or you've got a lot of money in a 401k, which you can borrow against with no tax penalty to use for your down payment. So people do ask me, I don't have enough money to put 20% down. Well, the good news, you don't have to put 20% down. And honestly, if that's all of your money, I'd rather you put maybe 5 or 10% down. That way you have extra money for maintenance for the house, to buy furniture, or just for a rainy day fund in case of emergencies. So the good news is though, with your assets, there's a lot of different sources that money can come from. So we can definitely go through that when we're getting you pre-approved and make sure that we find the right loan option for you and look at all the sources that you can have for your down payment and your closing costs. And so the fourth thing we want to talk about is what's called your debt to income ratio. And essentially this is all your minimum payments divided by your total income. Now, normally, most people are actually going to qualify for more of a house payment than they actually can afford or want to pay. So it's not because I told you you qualify for it. You want to make sure you have a budget done first to make sure that you're comfortable with a certain payment that's not going to make you house poor. Because the last thing that you want to do is buy a house so nice and really stretch your budget, because you're never going to be able to leave it because you don't have enough money to do anything else. And if you haven't done a budget, there's tons of resources online to do one. But a good place to start is look how much you're paying for rent right now, and then figure out, if I'm going to go over that for my house price, where's the money going to come from? So to recap, we really talked about 4 things. We talked about your credit, your employment income situation, your assets, and your debt to income ratio, or basically how much can you afford. So you want to make sure you cover all these things. And if you want to learn more, contact me for a free initial mortgage consultation. We can go over all this custom to your specific scenario and really get you on the path towards homeownership.